All right, we'll go ahead and get this started. If you don't mind turning on your camera, but definitely request that you please turn off your microphone. Before we get started, Erica will begin recording. Let me welcome everyone for attending. Thank you for taking the time out of your day to be here with us. We're going to be going over a quick methodology for analyzing an apartment deal, whether a property is financially worth investing in or even really just worth looking into more. Before I turn it over to Justin, just a quick intro to our team. I'm Whitney Hayes. I've been investing in real estate for many years, and a couple years ago started investing in multifamily real estate. I teamed up with Erica Thornton and Justin Pumpr here, and we started Mountain Guide Capital. We work with investors to purchase and operate commercial real estate. This training will be recorded and it will be uploaded to our YouTube channel at Mountain Guide Capital. If you like, please give it a thumbs up and subscribe to our channel. If you have any requests for future topics, please reach out because we'd love to do more. With that, I'll go ahead and introduce our speaker and my partner, Justin Pumpr. We're so lucky to have him here today. He's been integral into our team, and he's definitely like the numbers guy, and he has a wealth of experience in real estate and investing. He has an extensive single family home portfolio, and like I said, integral into our journey into the commercial space. So thank you, Justin, for joining us. We're ready to learn, and with that, I'll turn it over to you.
Awesome. Thank you, Whitney, and welcome everyone. So as mentioned, my name is Justin Pumpr. I'm responsible for acquisitions and underwriting here at Mountain Guide Capital. So just a little bit about me. I'm originally from England. I moved to the States in 2011 and started my investing journey in 2016 when I purchased my first home, which was a duplex that I then house hacked. That just means I lived in one unit and rented out the other. I then used the equity I built up in that property to get a HELOC, which I used to purchase my few rentals out of state in Columbus, Ohio. Since then, I've acquired 22 units, all of which out of state and none of which I have seen in person. I always knew the benefits of investing multifamily, and last year I made the transition into that asset class. And since then, I've looked at literally hundreds of deals all across the country. So a few goals for today. Hopefully by the end of the presentation, you'll be able to walk away and know how to very quickly discard or dig deeper into deals, as well as understanding some of the numbers and formulas used to evaluate them. So it's relatively high level here. I'm just going to give you the basic fundamentals of what to look at when looking at a property. Not going to touch on deep underwriting today because that is a very big topic in itself. So here's some of the questions we'll be answering when we look at an investment. These will let us know if an investment is a good one or a bad one, just letting us know if it's priced accordingly, letting us assess the risk on it, and most importantly, what returns are we going to get from it. So to do that, I'll be breaking down this presentation into 4 steps. Step 1's a precursor of things you should have already done before you start looking at deals, and I'll just touch on those briefly. Steps 2 to 4 are the steps I'll usually go through when looking at the deal, steps 2 to 4 are the ones I go through when looking at the deal. And while I'll touch on underwriting in step 4, I won't go into a lot of detail there because, as mentioned, it is a long presentation on itself. I will also say this will be a lot of numbers and formulas, so if that doesn't interest you, underwriting likely isn't for you, but it's still important to know how the numbers are calculated, so stick with me. Okay, so prep work. As mentioned, these are the things you should have done before you start looking at deals. They're not essential if you just want to practice analyzing, but some of them are essential if you actually want to start submitting offers. So at a high level, these should be defining your buy box. This is basically what property you're going after. What size is it? How old is it? What is your max purchase price, etc. By giving those parameters, it'll just help you narrow down what you're looking at even quicker rather than just looking at everything under the sun. Your return on investment, everybody's different here, so it really just depends on your risk levels. So decide what works for you. Your exit strategy, how do you plan to get out of the deal? Do you want to sell it? Do you want to hold it forever? That will help you adjust your returns and your ROI depending on how long you want to hold this property for. Your brand's really just getting a business email at this point, just because it makes you look more professional. You can build a website too if you want to that has info about you and your company, but if you're just a single person, just having a professionally looking email will help as well. And defining your markets too. Where do you want to buy? Similar to your buy box. If you know where you want to buy and what you want to buy there, it'll just make it much easier than trying to look at every property in every state all at the same And then broker relationships. Start reaching out to those brokers and building those relationships so they start sending you deals. This isn't going to happen overnight, so the sooner you start on that, the better. Okay, so on to the next section, which is the 1% rule. And what is the 1% rule? So this is a rule of thumb that states if the gross monthly rent is greater than or equal to 1% the purchase price, then the property should cover all expenses and hopefully cash flow as well. So as a high-level example, if we had a purchase price of $1 million and a total monthly rent of $10,000, then your property meets the 1% rule. So this is just a really quick rule of thumb, and while it is a useful guide, it's not going to show you returns, and it's not going to take into account debt, which in today's market is very high. But it will let you quickly discount properties, and we'll touch on this in a moment. When you know your market well, this is something you can do without even talking to a broker or looking at any financial documents. So it's just a really handy guide to use. So let's look at a few examples to see how we can put this into practice. So here you can see some actual listings from Crexi, which is an online portal for commercial properties like Zillow, but for larger multifamily and other commercial properties. So these are all in a market that I know, and in my opinion, none of these are good deals, which is why they've been sitting on Crexi for months at this point. The first one, for example, this is a $3.3 million property. So that would need to rent for $33,000 a month to hit the 1% rule. Now, I can see from here that there's only 12 units in that building. So they would need to rent for $2,750 per month, which as a long-term rental is never going to happen in this market. It's possible this is a student housing property, so maybe rents will be higher if they're being rented on a per room basis. But since we aren't interested in student housing, because that's not a part of our buy box, this isn't going to work for us. It's a similar story with the rest of these properties as well. By just looking at the purchase price and then calculating how much they can rent for, then we know how much they need to generate per month. We can really quickly pass this list and see if anything could be worth looking into further. So like I said, it's just a really high level rule of thumb that you can use to quickly go through a list and see if anything is going to be within your buy box and be able to closely get you the returns that you want. Okay, let's look at a slightly more in-depth analysis. So for this section, we'll do a quick analysis on a property. This may not seem quick as I walk through it, but once you have practice, this is something you can do in a few minutes, depending on the stage you get to. So I'm going to break this section down into 4 different sections, as these are essential to analyzing properties. That's the net operating income, the purchase cap rate, the property values, and finally the returns. Okay, so first off is net operating income, or NOI. So this is the income that is left over after all expenses are paid. This is a crucial number in multifamily investing, as it's used to determine property values, cap rates, and by lenders to determine the terms you'll get on your mortgage. Okay, so to work out your net operating income, we'll use this property as an example. This is an actual property that I analyzed recently, and it's a pretty typical deal we're seeing at the moment. So this is an 18-unit building with an asking price of $2.5 million in a market that has a cap rate of 6.5%. I'll talk more about market caps later because it's also another key number that you need to know. So at the moment, you can see the average rent per unit is $1,355 per unit. However, based on our market research, we know that the pro forma rents for this property are $1,580. Pro forma rents are what the property can rent for when it's been renovated based on what comparable properties are renting for. We can also see this was built in 1965, so we know it's a Class C building, which we can use later to determine the expenses. So we use the rent information and the class information to calculate the net operating income. So as mentioned, NOI is the annual income minus the annual expenses. So to work out the NOI, first we work out the annual income. So to do this, we take the number of units, which is 18, multiply that by the average rent per unit, and multiply that by 12, and that will give us our annual income. Then we work out our expenses. As we mentioned before, this is a C-class building because it was built in the 60s, so we know it's going to have a roughly 50% expense ratio. That just means that 50% of the income is going towards expenses. This is just a rule of thumb and not an exact number, but that's honestly all we care about at the moment. So we multiply our income by 50% to get our annual expense amount of $146,340. Then to get our NOI, we subtract the expense amount from our annual income, and that will give us a net operating income of 146,340. So with the 50% expense ratio, we could have just halved the income here. I just want to show you this formula because if you're dealing with a different expense ratio, then you'll need to adjust these calculations accordingly. In general, a newer building has a lower expense ratio. For instance, you'd expect a building built in the last 20 years have around a 35 to 40% expense ratio, depending on how well it's been taken care of. So now we have our NOI for this property. We can use that to purchase the cap rate, to work out the purchase cap rate. So what is the purchase cap rate and why is it important? The purchase cap rate is an indicator of the value of the property. And it's important because it shows us if the property is priced in line with the market cap rate. The market cap rate is a cap rate at which similar properties in the market have sold for. So the purchase cap rate is a cap rate we'll be buying the property for. The market cap rate is a cap rate of which similar properties in that market have sold for. Now, if our purchase cap rate is lower than the market cap rate, then it means the property is overpriced. If it's higher than the market cap rate, then it could be a good deal, or it could just mean that it's a riskier investment. This number is also important because if the purchase cap rate is less than the interest rate you're getting on the loan, then you'll have negative leverage. And this means the rate you're paying on the loan is higher than the return you're getting on your investment. And honestly, this is why it's really hard to find good deals in today's market because interest rates are so high and cap rates have not increased as interest rates have gone up. So how do we work out the purchase cap rate? So we take the NOI and divide it by the purchase price. So if we go back to our example, we have our net operating income of 146,340 and an asking price of 2.5 million. So to work out the cap rate, we divide the NOI by the purchase price, and we get a 5.8% cap rate. Okay, so what does that mean? So if we look at our numbers again, we can see that the purchase cap is less than the market cap. That means this property is overpriced and it's priced higher than similar properties that have sold in the market. It's not massively far off, so I think there's room to continue looking at this deal. If they were trying to sell this at a 3 or 4% cap rate, I probably wouldn't bother looking any further. Or at least follow up with the broker and ask them how they got to their valuation and how they're justifying such a low cap rate. Okay, so we can see that our property is a little overpriced, so let's work out what it should be worth. And to do that, we'll use the NOI gain, but this time we'll use the market cap rate. So we take the NOI and divide it by the market cap rate. So that's 146,340 divided by 0.65%. And we get a current value of 2.251 million. Okay, so it's not a terrible difference, but it's definitely a lower price. If it was more than 40 to 50% below, I probably wouldn't bother. But this is close enough to keep on looking at this point. Okay, so now we know what it's currently worth. We also want to know what it can be worth. So very similar calculations to before, except this time we'll use the pro forma rents. Remember, pro forma rents are the rent we can achieve once we've updated the units and brought them in line with the comparables. Okay, so if we take the NOI and divide it by the market cap rate, so this time we're going to use the NOI based off the new rents. So first we work out the NOI using the same calculation from before. When we worked out our NOI, except this time we use pro forma rents. So we take the pro forma rent of 1,580 per unit, multiply that by the number of units, multiply that by 12 to get our annual income, multiply that by our expense ratio, and then divide that by our market cap rate, and we get a pro forma value of 2.625 million. Okay, so now we can see pro forma value is not much more than the current asking price. So we know for sure that it's priced too high. We already knew that based on the purchase cap rate and the current value, but we can also see that if we were to buy asking price, there's really not any profit to be made when we sell the property either. So how do we know how much money we can actually make on this deal? So for that, we need to look at the returns. So there's two metrics that are easiest to calculate and give us the most information. They're cash on cash and equity multiple. So think of cash on cash like the annual interest rate you'd receive in a savings account. So if you invest $100,000 and get $10,000 back per year, then you get a 10% cash on cash return. The absolute minimum we want is 8%, but we really want 10% plus, especially for a Class C building. And that's the number we aim for because we want to make sure that we make more money here than we can with the S&P 500 or with the savings account. However, cash and cash only shows the money we receive from cash flow. We're also going to get money when we sell the property, and that's where equity multiple comes in. So equity multiple is the total return you receive against the amount you invested, and it includes cash flow or profits from the sale. So if you invest $100,000 and you get $50,000 back from the sale of the property, plus the $50,000 you receive in cash flow over 5 years, then your total return is $200,000, which is an equity multiple of 2. This is the minimum we aim for, but we have seen other teams offering 1.8, which in today's climate is still not a bad return. Just really depends on the amount of risk in the property, how conservative they are on the underwriting, and there's a few other factors that play into it. As a rule, it's always better to underpromise and overdeliver. Is it possible to get higher returns if everything goes right? Possibly, but that's a lot of risk. So make sure to be conservative to leave yourself some wiggle room. That way, again, underpromise and overdeliver. If things go better than you said they were going to, then that's going to make your investors very happy. If you promise the moon and then underdeliver, they're going to be pretty annoyed. Okay, so how do we calculate those two metrics? Well, it's very simple. Just these few little formulas. Okay, don't panic. I'm not going to run through all of these, or expect you to remember them. While they are actually relatively straightforward when you understand where they all came from, we don't need to manually work them out. And that's because we have a spreadsheet to do it for us. Okay, this is the spreadsheet I use for my high-level calculations. It was actually given to me from another group that I'm in, and I just modified it over time to tailor a little bit more to what I'm after. So I use this when I decided that a deal is worth looking into more. And for this deal, the asking price isn't too far off what it's currently worth, and we know there's room to raise rent, so it looks like there could be a deal there. So I'll use this analyzer to see what returns we can get and to tweak the numbers. So everything here in green are the numbers you input yourselves, and everything in yellow is what it spits out. I'll make this available for everyone at the end as well, so you don't need to make your own, and it might be a little bit hard to see here as well, but I will break this down a little bit further. Okay, so the first thing we need to do is add in our market cap rate. This is going to drive a lot of the numbers in the spreadsheet. And then from there, we'll add in the number of units. Already you can see what the current value on the property is based on the NOI and the market cap rate. Then you'll add in your asking price, and this will show us what the cap rate the seller is asking for. So on the top left, we can see the market cap rate is 6.5 and the asking cap rate is 5.85. So we know the cap rate is lower than market, so we'll adjust our offer price to be the current value to see what that spits out. Okay, so we've got our offer price in here of 2.2 million. Then we'll add in our pro forma rent numbers and the expense ratio. Again, this is a C-class building, so I'm going to put expenses at 50%. And then from here, we can already see the pro forma value has been calculated for us. We can also see the pro forma cap rate is there as well. So when we buy, we generally want the pro forma cap rate to be 200 basis points above the purchase cap rate to give us enough spread. That's when we know it's going to be a good deal. Okay, so if we add in our debt numbers, so this is going to be the interest rate and the loan to value amount we expect to get. To get really accurate numbers here, you'll need to talk to a lender and send them the current financial docs. Then they'll be able to give you terms. In the current climate, a 6.75% interest rate is relatively safe at anything over $1 million. And ideally, you want to get 75% loan to value, as that means we're putting 25% down. This is generally the minimum you'll be putting down. Some lenders want to see 35%, but it really depends on the NOI and if there's enough there to cover the debt payments. That's the DSCR number, which is shown at the bottom here. So the majority of lenders are going to want the DSCR to be at least 1.25. We can see here they're a little bit below that, so we'll need to bring a bigger down payment or get a reduced asking price. Okay, finally, we'll add in our rehab numbers, which is separated into exterior and interior. You're almost always going to have some kind of exterior rehab. We like to update the exterior first to show the tenants we're investing in the community. This just helps build trust, and if there are any rent increases, it just goes a long way to show that we've invested in the property. And if there are down or vacant units, then we'd also renovate those in tandem with the exterior as well. For the interior rehab on this property in particular, we're putting in $10,000. This is just based off the photos and just knowing the market and knowing what costs are on that market. And we're just expecting this to be a pretty light cosmetic update. Okay, so with all of our inputs added, you can see some of the calculations done for us. These are all useful numbers, but the ones we really care about are the overall returns. So you can see here our stabilized cash on cash is only 4.75%, and our equity multiple is 1.29. So remember before, we said we want this to be at least 8% cash on cash and closer to a 2x equity multiple. So right off the bat, we can see here that this is just, it's not going to be a good deal. Regardless of even though it's priced what it's worth, there is not enough money in this deal for us to make it a worthy investment for us. So we already know that we're below their asking price, so getting them to accept lower could be tricky. However, it doesn't cost anything to submit an offer, so feel free to play around with the asking price until you get a number that works for you and the returns that you want. On this property, I worked that out to be around 1.725 million to get close enough for it to be worth our time. You can see here that gives us almost double-digit cash on cash returns and an equity multiple of over 2. So this is looking pretty good. It's pretty far off the asking price though, and again, sellers are still pretty stubborn at the moment. So it's unknown whether they would actually accept this one. One thing to keep in mind is these are pretty high level numbers. This is just meant as a quick analysis to see if the deal is worth looking into further. When you do get into full underwriting, you may find these numbers are slightly better or slightly worse as you dial in the expenses. But if the returns are high enough here, then that's enough info to decide what to do next. So what are the next steps? Oh, sorry. Okay, well, if the deal's heavily overpriced, submit an LOI anyway, and follow up with the broker and explain your analysis. So LOI stands for letter of intent, and it's a non-binding offer letter. As I said, it doesn't cost anything to do this, and it shows the broker that you've taken the time to look at the deal in depth. Just make sure to explain how you got there and be humble about it as well. Tell them this is the price you need to be at, and you understand if it's low and it's not going to be accepted, but just to keep you in mind in case anything changes. If the deal looks good and is close to the asking price, then I'd say go ahead and do a full underwriting. This is just to give you practice as much as anything, but also just to validate your numbers. If the numbers are still looking good during underwriting, then again, submit your LOI. And make sure to follow up with the broker after you submit them, and again, explain how you got there. Even if the offer's low and they're rejected now, they may come back to you again in the future. If it doesn't sell, then they may come back and see if your offer is still open. I had one broker reach out to me 6 months after I submitted my initial LOI, asking if I was still interested in purchasing the property. Okay, so if you do decide to do a full underwriting, then that would be your next step. This is where you'll take a deep dive on all the financial docs and really start to pull apart the operations of the property. There's likely going to be a lot of back and forth here with the owner or the broker, depending on who you're talking to. Plus, you're going to want to confirm insurance, taxes, property management fees, rents, etc. There's a lot that goes into this in itself, and there's a lot of dials that you can push and pull here to try and make deals work. Again, it's a lot on its own, so I'm not going to go into that now. Doing a full underwrite also requires the use of a more complex spreadsheet. There are a lot of tools out there for that. The one I use is called Synthesis. And you can see here it has a lot more detail. This will help you project your returns over multiple years. You can see everything in a lot more detail. You can your closing costs, your acquisition fees. You can just do a lot more of a deep dive on a deal here. When you're starting out, this is probably going to take you an hour or two, honestly, to move all the numbers over, get all your market data in there and really understand where a property is. But once you've got this down and done it a few times, you can get this down to be done pretty quick. You're still going to have that back and forth with the brokers. You're going to need to ask questions on how many units have been renovated, what's been replaced, what needs updating, deferred maintenance, etc. So that will take as much time as what the actual underwriting portion does. In terms of Synthesis itself, I think this one costs around $150, and there are training for that on the website. Don't worry, I do not make any money from this. I do not sponsored by them. It's just I found this is the tool that works for me. I know a lot of people use Michael Blanc's syndicated deal analyzer. There's another one as well. In my opinion, this is the one that's helped me underwrite quickly and get the numbers where I need to be. Okay, so that was basically the presentation. So to recap, do your prep work and get ready to start making some offers. Once you find or get sent a property, see if it hits the 1% rule. Then do your quick analysis to see if the deal is worth looking into further. And if it is, and you're moving forward, do the full underwrite. And if not, you can do it all again. If you do get into contracts, it's then on to due diligence. and hopefully flows on the property, execute on your business plan, and then this will be you.
Thank you, Justin. I like the picture.
The power of AI.
With that, well, I guess we can open it up to questions. If anybody has any, feel free to throw them in the chat, or you can go ahead and say it now. Erica, if no one has anything, I think Erica's collected a few from prior.
Yeah. Does anyone have any questions? Feel free to unmute and hit us with your question. If not, I'll wait a second, and then we'll go into some submitted questions.
Did you have AI do that photo, Justin?
Sure did.
All right, cool. So one of the questions, so Justin came and presented at, we have a meetup in Monterey, and so we pulled some of those questions that we typically get asked from this presentation. And so one of them was, what are some methodologies that you use to come up with the pro forma rents?
Yeah, so I mean, there's a few sites that you can use to like roughly gauge it. They cannot be the most accurate sometimes. So like Rent-A-Meter is one of them. It's a paid service, and that will show you historical data from the market you're looking in. It's a rough guide that you can use, but really you want to be validating that with the property managers in the area just to confirm that they are the numbers you can get. If you've got very deep pockets and you can afford to splash out, CoStar is probably your best bet, or something similar. I think there's CoStar, Yardi Matrix, and RioKnow.me, but they're pretty expensive. We're talking hundreds, possibly thousands of dollars a month, depending on how many people are using it. So when you're starting out, just using your market knowledge will help a lot here as well. Sometimes the brokers, they will give you an OM, which is an offering memorandum, but they will list out what they think the pro forma rents are. Again, just check those. Other brokers, they send us deals. Sometimes they overinflate what the projected rents are going to be, and we'll use, in my opinion, incorrect comps in there as well. So use those as a guide, but then definitely validate them with people in your network and boots on the ground as well.
Awesome. Thanks, Justin. Okay, question number 2. What are some of the challenges that you're experiencing with underwriting and trying to make deals work right now?
Yeah, so debt is definitely a big one. As I mentioned before, debt is still high. Cap rates are still pretty low. Sellers still think it's 2021, 2022. And some sellers bought at that time as well, and they're trying to get out of those deals, and they're losing money on them because people can't afford to pay what they paid for them when they were getting 3% interest rates. So that is definitely a big challenge. Insurance is one as well. Insurance has skyrocketed, especially on the coastal regions. Even inland Texas has gone really high. I was underwriting a property the other day. I was being pretty conservative, underwriting to $850 a door. Got an insurance quote back, and it was over $2,000 a door, which just completely blows your numbers out of the water. That might change in the future, but at the moment, I think the insurers are really feeling the burn from all the claims that have been had. Other challenges just in general can be just getting the right documentation as well. As I mentioned, the details you get from brokers sometimes are not the most accurate. So that could be a challenge. So you have to sift through that documentation and then validate it. And then if you're dealing with more mom and dad owners as well that don't have the most sophisticated paperwork, sometimes you have to make a lot of assumptions there as well until you can get in on the property, or just the record keeping can literally be a piece of paper with some hand-drawn numbers as well. So trying to transfer those across and deciphering those can also just be a bit of a challenge too. But yeah, they're probably the main ones at the moment. Yeah.
Okay, awesome. All right, question number 3, with interest rates being super high, we are always hearing use creative financing methodology. So can you talk to us a little about some of those and how those are working out?
Yeah, for sure. So assumable loans are a big one. I see a lot of deals getting done with those at the moment. So an assumable loan just means that you are assuming the current owner's loan. So if they were able to buy that in 2022 and they got a good low interest rate, then you can take over that payment, which will make your deal a little bit easier to manage. That said, normally when that happens, the price can be a lot higher as well, or there was a very large down payment which is required to bring in. Some of these loans do not allow supplemental loans. So if they're asking $10 million and they've got an assumable loan of $2.5 million, that's great, but you've still got to find $7.5 million from somewhere. So at that point, you might be better off going out and getting a whole new loan because you can bring less money to the deal. Unless you can get the seller to agree to some kind of seller financing, which is one of the other methodologies we look at as well. So every deal we look at, we always submit an offer with a all purchase paid at closing, basically getting new funding from a bank or a lender. And then we do another one with some form of seller financing because we can usually go up a little bit higher on the price at that point. So if we can get the seller to carry the down payment, then that'll allow us to come up a little bit. But if we can get the seller to finance the whole deal, if they own it free and clear, then we can really negotiate the terms pretty heavily there as well. We can potentially bring a lower down payment. We can get a lower interest rate. We can negotiate the length of the loan, when the payments start. There's just a lot more freedom in that. In general, they're pretty hard to come by, especially if you're dealing with brokers. Having that extra person in the middle and not knowing what they're communicating to the seller can be a challenge. So really, to make this work, you kind of want to be having those conversations directly with the seller.
All right, awesome. Thanks everybody for your time. Any other questions before Whitney closes us out?
All right. Yeah, if you guys have anything after, please feel free to reach out to us. That's our website right there on the screen, mountainguidecapital.com. My email address is whitney@mountainguidecapital.com. If you have any questions. Again, if you like this video, it will be uploaded to our YouTube channel, which is also Mountain Guide Capital. And you can go ahead and like and subscribe. If you have any requests for future topics, let us know. We love doing these. We love sharing the wealth of information and knowledge. So we'd be happy to entertain any other ideas you have as far as topics for the next one. With that, thank you guys for your time. Justin, thank you again for sharing with us. It's just really invaluable. Knowing the numbers is such a huge part of being able to make this a profitable business. So we really appreciate your time. All right. With that, we'll see you guys later. Have a good day.
Cheers. Bye.